What if you could compress 5 years of growth into one bold move without turning your life into a 24/7 stock ticker? I'm Mark. This is Dividend Hustle. And today we're filling my real portfolio pie with 9 high-growth stocks tied to the technologies actually creating value right now. AI, cyber, fintech, and even quantum. Quick reality check. If you'd put $10,000 into NVIDIA 5 years ago, it'd be about $150,000 today. That kind of jump happens when the right product hits a fast-growing market at the right time. The trap? Chasing thumbnails that scream 140% annually? Insane. Buying late and building a portfolio that feels like freedom, but behaves like a death trap at the first drawdown. Here's why you should care. One great decision can tilt your next decade. One sloppy one can set you back years. In the next few minutes, I'll show you the 9 buys I'm making now, why their products, not just their numbers, win, the specific risks I'm watching, and a simple plan so $5,000 or $50,000 doesn't get wrecked by FOMO or headlines. No hype, calm, confident, educational. If you want a list you can actually hold through the scary parts, stick with me till the end. Hold up, quick pit stop so we don't blow the engine. Here's how we keep our hands from lighting this portfolio on fire. First, sector rotation is real. Money can slide out of tech and into energy/financials in a heartbeat. That doesn't change a great business, but it can crush a quarter. So, buy now on this channel means buy with a multi-year product thesis, not a trade for next Friday. We size positions so no single name can torpedo the pie. We expect volatility as the toll for growth, and we decide how to enter. Lump sum if you'll. Otherwise, procrastinate. DCA if headlines spook you. My rules for picking winners are simple and strict. 1. A moat I can explain in one breath. Network effects, switching costs, brand, or unique. Assets. 2. High and durable, ROIC. 3. Gross margins that hold or rise over a decade. 4. Balance sheet strength, cash greater than bravado. And 5. Recurring cash flows tied to real products people actually use. Bonus points for resilience to tariff/reg/tech shifts and for multiple profit engines. Not just one hero product. All right, how I pick these, no hype. Just receipts. I start with the product, not the PE ratio. Does it solve a painful problem? Is adoption accelerating? Are there clear cross-sell paths or network effects? Then I zoom out. Long-term charts across full cycles, including drawdowns, to see if the business composes through chaos. I trace the cash engine, free cash flow, operating leverage, R&D that pays for itself. Finally, I want real pivots on the resume. Cloud transitions, platform moves, AI layers that show management adapts. Risk/reward stays sane with position caps, a rules-based annual review, and upgrade the slot if 2 core metrics break. Moat erosion, IC/margin. Trend down, leverage creeping up. No hero trades, just repeatable process. Let's start with number 9. SoFi, the fintech flywheel you can feel. What it is, a one-stop digital bank/broker with a financial services productivity loop. Start a customer with checking/savings or invest, then graduate them to higher value products, personal, student, home loans, and workplace benefits. Why it wins? The loop raises lifetime value. Members who come through the ecosystem tend to be roughly 2 times more valuable than one-off loan shoppers. Cross-sell lowers acquisition costs. The bank charter improves unit economics and new offerings, like access to private markets, alternatives for Main Street investors, expand the addressable wallet. Real-life proof. Recent results showed accelerating adjusted revenue, approximately plus 74% year over year, and adjusted EBITDA margin around 29%. Signaling scale with discipline. Management continues to push product velocity while tilting more origination toward platform lending for other institutions. Fee income without holding as much rate risk. The member base skews high income, personal loan and student loan borrowers averaging 6 figures plus, supporting credit quality. Risk check. 2 dials matter. Rates and delinquencies. A sharp rate drop, often tied to recessions, can hit net interest income and loan valuations, while industry-wide delinquencies have been climbing off post-pandemic lows. Competition is fierce across every lane. Banks, brokerages, wallets. What could break it? A quick macro turn that spikes charge-offs, fumbles in risk controls, or a stall in cross-sell that exposes high acquisition costs. Execution missteps on new products or regulatory hits could compress margins. My move. Keep SoFi as a smaller growth weight, add via DCA and monitor three tells: cross-sell adoption, credit trends, and the mix shift toward platform fees. If two of the three slip for more than a couple quarters, I upgrade the slot. Next up, number 8. Nubank, the LATAM super app sprinting into Mexico. What it is: a mobile-first everything finance app, payments, credit, savings, investing, built for Brazil, now expanding in Mexico and Colombia. Why it wins: super low-cost customer acquisition and a sticky bundle. Once someone pays with the app, they're more likely to try credit, investing, or small business tools. Localized products plus a founder back at the wheel equals speed. Real-life proof: triple-digit million user base in Brazil and fast adoption in Mexico after securing a banking license. Credit card share is tiny in Mexico, so runway is long. Risk check: macro shocks, FX, rates, credit cycles, and competition from banks and telco wallets. What could break it? Overextending credit into a downturn or mispricing risk in new markets. My move? Starter position, add-on pullbacks, track Mexico active users, take rate, and credit losses. Rolling to number 7. PayPal, beaten up value with a wallet of the future bet. What it is: a global checkout network. PayPal plus Venmo, mid-turnaround. Modernizing 20-year-old rails and pushing a true digital wallet vision. Why it wins: massive merchant acceptance, peer-to-peer ubiquity, Venmo, and the ability to push new checkout flows. BNPL one tap, card tokenization. Real-life proof: restructuring to streamline costs, steady share buybacks, growth pockets in Pay with Venmo and BNPL. Working on an interoperability layer to make cross-border payments less painful. Apple/big tech wallets at checkout, margin pressure during the rebuild, and execution risk on new products. What could break it? Failure to deliver a cleaner, faster default checkout and a wallet that works across borders, plus any renewed fraud spikes. My move: value slot, accumulate while sentiment is sour, watch margin recovery and active account quality, not just headline MAUs. Number 6. Google/Alphabet, AI roots plus cloud acceleration at a discount. What it is? The search/YouTube giant with deep AI research, DeepMind, and a fast-growing cloud platform. Vertex AI data/ML tooling. Why it wins: distribution, search, Android, YouTube, plus AI tooling that enterprises actually use. Cloud growth can re-rate the multiple if operating leverage shows up. Heavy capex into data centers, cloud revenue growth outpacing hyperscaler peers at times. Gemini everywhere, from dev tools to phones. Risk check: AI answers can cannibalize ad queries. Regulators will always circle. Capex payback lags. What could break it? Under-monetizing AI while costs surge, or a prolonged ad slowdown without cloud margin lift. My move: core growth weight. I'm buying the cloud slope, not a quarter. Track cloud margins, and user engagement in AI features. Number 5. Uber, rides, delivery, and an underrated AI/services engine. What it is: a logistics platform, rides, delivery, freight, with a growing data/AI services muscle and partnerships in autonomous. Why it wins: two-sided networks at global scale, improving take rates and optionality as autonomy arrives. Partners ride your rails instead of replacing you. Real-life proof: rising trips and gross bookings, strong EBITDA trends, and an authorization for sizable buybacks. Confidence signal from management. Risk check: autonomy risk, regulatory swings, and local competition. What could break it? A rapid closed robo-taxi rollout that bypasses Uber's network, or a hit to take rates from regulatory caps. My move: mid-size position, watch unit economics per segment, and the pace/shape of AV partnerships, not AV headlines. Number 4. CrowdStrike, AI native security, leaderboard receipts to prove it. What it is: cloud-first endpoint and workload security with an expanding module platform, identity, cloud, data protection, all stitched by AI. Why it wins. Land and expand flywheel. Customers start with endpoint and add modules. Every breach headline raises willingness to pay. Real-life proof. Multi-year leadership callouts from major analyst firms, and industry-leading net retention as customers adopt 6 to 8 plus modules. Risk check. Platform concentration risk. A big outage hurts. Rising competition from bundled suites and valuation swings. What could break it? A prolonged platform failure or pricing pressure from mega suites that undercut standalone vendors. My move. Core cyber weight. I accept volatility for multi-year growth. Track module adoption, ARR per customer, and gross margin durability. Number 3. Zscaler. Zero Trust Gatekeeper riding the ransomware wave. What it is, a secure cloud gateway for users' trademarked apps. Zero Trust Network Access, SSE, that replaces legacy VPNs and castle and moat networks. Why it wins? Architecture matches modern work. Apps in the cloud, users everywhere. Zero Trust reduces attack surface and blast radius. Real-life proof. Rapid revenue growth, improving operating leverage, and strong large customer adds as AI-driven attacks spike. Risk check. Still premium valued versus profits today. Big platform peers are bundling. What could break it? Slower enterprise migrations or pricing pressure from suites that good enough the category. My move. Growth slot with room to run. Watch path to GAAP profitability, large deal velocity, and attach of data protection modules. Number 2. QTUM ETF. Quantum exposure in one basket. Yep, an ETF. Here's why it belongs. What it is. A themed ETF targeting quantum and adjacent compute. Mix of pure plays plus the AI/semiconductor names that will benefit as quantum scales. Why it wins. Diversified way to participate in a nascent market without single-name science risk. You still capture upside from enabling chips/software. Real-life proof. Holding span lasers/photonic gear, early quantum startups, and heavyweight beneficiaries. AI/data center. Silicon software. Risk check. Theme ETFs can drift toward adjacent holdings. Fees versus owning names directly. Not a pure quantum proxy today. What could break it? Prolonged winter in quantum commercialization, or a narrow winner-take-most outcome the ETF underweights. My move, small satellite position, rebalance annually. Use it to avoid picking the wrong horse too early. And at number 1, IBM. Quiet quantum operator with real machines and customers. What it is. An enterprise stalwart building a practical quantum stack. Hardware, control, error mitigation, and developer tools. Deployed in multiple regions. Why it wins. First mover credibility with actual systems in the field, paying clients, and deep ties to industries, health, finance, research, that will adopt earliest. Real-life proof. Systems installed beyond the US, active research/programs with enterprises and universities, and a roadmap that steadily increases qubit quality and scale. Risk check. Timelines are long. Classical plus AI will dominate near term. Legacy business mix can blur quantum's contribution. What could break it? Stalled hardware progress or faster breakthroughs by rival architectures? My move. Patient, long horizon hold sized small. Track roadmap milestones, quality rates, real customer workloads, and ecosystem growth. Real talk. Green lines don't go up forever. If you own high growth names, you will see 40 to 70% drawdowns. That's not a bug, it's the toll. A minus 50% drop needs a plus 100% climb just to break even. That's why people panic. But zoom out. A basket that compounds 10 to 12% annually for 10 to 25 years can absorb a few brutal storms and still change your life. The trick is building a ship that survives the storm, sane position sizes, multiple profit engines across the pie, and a pre-commitment to hold through volatility. We're not trying to dodge every red candle. We're trying to make the next decade's math inevitable. Myth-busting minute. Let's flip a few bad takes. Rates kill all growth. Higher rates raise the bar, they don't end compounding. Real businesses with pricing power, sticky demand, and improving unit economics keep marching. We size risk and extend our timeline. Problem solved. Only small caps moon. Plenty of large platforms compound faster precisely because scale unlocks margins, cross-sell, and network effects. Size not equal dead money. ETFs always win. ETFs are a great default, but a concentrated basket of dominant, cash-rich growers can beat the index if you actually hold them through the ugly parts. Process greater than prediction. Set and forget equals never review. Nah, set and forget means no fidgeting. We still do a rules-based annual review. If the thesis breaks, we upgrade the slot. Calmly, not reactively. Okay, your $5,000 or $50,000 plan. Exact next steps. Step 1. Entry plan you'll stick to. If headlines make you freeze, go 50% now. 50% over 4 to 6 months on fixed dates. If you're steady under pressure, lump sum usually wins because time and market greater than timing the market. Either way, automate the buys. Step 2. Simple weights across this 9-stock pie. Bedrock, steady 30%, Google Alphabet 15%, IBM 10%, PayPal 5%, Flywheel Growers 60%, CrowdStrike 15%, Zscaler 12%, Uber 12%, Nubank 11%, SoFi 10%, Optionality Unlocked Theme 10%, QTUM ETF 10%, Broad quantum exposure without single-name science risk. $5,000 example. Alphabet $750, IBM $500, PayPal $250, CrowdStrike $750, Zscaler $600, Uber $600, Nubank $550, SoFi $500, QTUM $500. $50,000 example, same percentages. Just add a zero. If your broker allows, turn on Dividend/DRIP or auto reinvest for all 9. Step 3. Annual upgrade rules. Same week every year. Ask 5 questions. Is the moat shrinking? Users, switching costs, brand, or tech edge? Is ROIC/efficiency trending down for more than a year? Are gross margins compressing structurally, not just a promo cycle? Is the balance sheet weakening? Debt up? Cash down? Dilution? Are recurring cash flows and adoption, modules, users, transactions, stalling? If 2 or more fail and it's not a temporary cycle blip, upgrade the slot to a stronger name. Rebalance back to targets annually or when any weight drifts plus or minus 5% beyond its band. Never sell because of price alone. Sell because the business changed. Automate contributions, keep notes on each thesis, and let the next 10 to 25 years do what the next 10 headlines can't. All right, here's the no BS toolkit you can use tonight. Automation beats willpower. Open your notes and lock these in before bed. Auto transfer on payday. Push a fixed percent or a dollar amount from checking to your brokerage the day you get paid. No gaps, no, I'll do it later. Auto invest the pie. Schedule buys into the 9 tickers at your target weights. Turn on DRIP/reinvest for every position. Quarterly 15-minute health check. Calendar it now. Glance at revenue growth, gross margins, share count, dilution/buybacks, debt/cash, and any product/SEC headlines. No price chasing, just health. 1-page investment policy, IP. Write your rules in plain English. Position caps, DCA cadence, the 5 annual upgrade questions, and what triggers a trimmed. Keep it visible. 2 buckets for sanity, emergency cash, 3 to 6 months, separate from investing. You protect the plan by avoiding forced sells. Password +2 FA hygiene. Brokers, email, authenticator app. Security isn't optional. Red flag triggers, if to fire, review the slot. Moat erosion, users stall, switching costs fall, or a competitor closes the gap. Efficiency slippage, ROIC or operating leverage, deteriorates for 4+ quarters. Margin compression that sticks, not promo noise. Structural. Balance sheet stress. Net debt climbs, cash drains, or serial dilution funds operations. Customer signals. NRR/churn worsen, big outages, or top customer concentration rises. Governance smoke. Auditor changes with weak explanation, CFO churn, or regulatory actions that cap pricing. Pick your savings frame, lean, coast, or barista, and be honest. Lean. Short sprint, high savings, 30 to 40% for 3 to 5 years, to front-load compounding. Best if you can crank for a season, then relax later. Coast, you've funded enough that normal contributions keep you on track. Investments do most of the lifting. Protect time and sanity. Barista, flexible income/side hustle covers life while you invest steadily. Lower stress, high consistency. Choose the one you'll actively stick to, then automate it. Before we wrap, your promise to future you. I will play decades, not days. I will own real businesses, size risk like an adult, review by rules, not by mood, and let compounding work while I live my life. Calm greater than adrenaline. Your move. Make the comments smarter. Drop your #1 high growth buy now and why. I read every take. If this gave you clarity, like the video, subscribe for the deep dives on each pick, and share this with the friend who can't stop overtrading. Let's build freedom the boring way together.